Hello and welcome to Advisors Lodge. We have a great episode planned for you today. But before we start, we want to let you know about a very special last episode of our series. So in this last episode, coming up in a few weeks' time, we want you to ask us anything. So please write in if you want to know anything on how to deal with certain types of customers, or you need any career advice as well.
Or maybe you have a burning question, about the financial markets, or you want to know more about an investment solution. Whatever your questions, we have experts to basically answer all of them for you. So don't be shy. Please send us your questions. We are ready to answer them.
Great. So let's get on to today's episode. As advisors, I guess, as we started off, we were thinking how do we even start recommending clients our investment solutions and so on and so forth. So for advisors who are honing their skills and investment skills, maybe recommending a ready-made portfolio is something that it could be an easier task than constructing one from scratch. So how do even advisors gather information about their clients to draft a well-rounded portfolio, or should they really go for a ready-made portfolio solution as a more efficient method? So we are here today with Kek Wee, the head of investment at Unicorn Financial Solutions, to pick his brains and also to learn from his many years of experience. Welcome, Kek Wee.
Hi, Roger. Hi, Albert.
Yeah.
So let's start off quickly. Firstly, so could you actually share a little bit in terms of an investment portfolio versus a collection of funds and asset class?
Maybe I give an analogy instead.
Great, that's good.
So I think building an investment portfolio is more like a house that is built via design.
Okay.
Yeah. So a collection of funds is just like building a house from an assortment of building materials.
Right.
I see.
So with that of a well-designed house, so the materials could be exactly the same.
Okay.
But it is true that thoughtful design, where to place the wall, what kind of furniture complements each other. Then at the end of the day, it will be a house that is to the comforts of the owner and to the preference of the owner. Whereas I could use the same materials and I just build it, without any design. I think it will be a place the owner can't even live in.
That's true.
So that is so with a proper investment portfolio, so we'll do asset allocation that's suitable to the owner of the portfolio, and then a proper diversification, things like that.
I guess is to add on that probably is like an ID.
Yeah.
So with the portfolio, I guess is getting an ID to help to design the house according to the needs and the ones that the clients is looking for, the style, the colors, the adjustments. I don't know what kind of length of the curtains needed as well, probably. The collection is probably somebody like us, we don't have the expert view from the ID itself, probably, let me just put the materials here, put the cement, put the tiles, and then that's it. I'm happy to live in.
Yeah, because all you know is like, this is the kitchen, but you don't know the nuances of like what's needed in the kitchen and all this kind of thing, right? For you as a basic, home user or an idea of having a home is basically, I need a kitchen, I need this, but there's many details that go into it. Just like collection of funds as well, right? In a certain asset class, you have so many of funds that is you go into, let's say, global equities or even into China. But which one is like, really suit the portfolio? You need to do a lot of research, and I believe that's where your expertise basically comes in.
So I work with my team of analysts to support the advisor.
Right.
So they don't have to look at the bolts and nuts.
Correct.
But the design-wise, we actually co-design it with the advisor, because it has to be from the inputs of the end investor, not just based on isolation from the investment team.
That's right. Yeah, because you got to have two-way communication from the
The
ground.
advisors will know the client better.
Yes,
exactly.
So, in that manner, when advisors want to help, clients construct a portfolio, what are the top 3 things that they must know about their client?
So number 1 is the tolerance to volatility.
Okay.
Number 2 is the time horizon towards their goal. Number 3 is their financial capacity.
Okay.
So I explained the 3.
Okay.
First, tolerance towards volatility. Okay. So it's maybe it's like me taking a roller coaster. I don't have a big appetite for a roller coaster. So you give me a scale 10 one, the hyper aggressive kind.
Yep.
I'm sure the roller coaster will come back to its original place. But whether I come back alive, that's another matter. Maybe I'll have a heart attack somewhere along the way. And I won't make it back alive.
Okay.
So it's just like, if a person construct a portfolio, there's not in line with their tolerance. Because volatility can be huge for equities markets. For example, in the global financial crisis, stock market generally dropped between 60 to 75%.
Yeah.
Yeah. So, but today, if you look back, it's just like a little blip. Yeah, we are way beyond that level.
Yes.
Yeah. Just look at S&P was 1,005. Yeah, today it's about 5,000.
Yes.
But the thing is, if both those people who have sold because they cannot take that volatility, 5,000 today is meaningless to them because they have lost money when they sell during the crisis.
Yes.
Yeah, so it's going to be suited to the tolerance of a volatility.
Okay. Okay.
Number 2 is the time horizon. Yeah, because I did a study. Let's say I just take the last two big crises, the .com crash and then the global financial crisis. So the .com crash, it took about 7 years, from peak back to the peak. For a global financial crisis, it's about 5.5 years.
I see.
So let's say if I need the money in 3 years, and unfortunately, where I'm now is the peak of the market. And if 3 years later I need the money, then I may be forced to sell at a loss, maybe a big loss. So I think it's important to match that. So let's say if my time horizon is very short, then maybe I shouldn't be much exposed to equities. It should be more towards maybe fixed income or maybe even cash or CPF. Just keep it there. Then number 3 is the financial capacity. Maybe I'll give you like an example. So let's say there are 2 persons, A and B. Okay, and both needs to achieve $1 million in 10 years' time. Okay, so A starts with nothing, and he can only save 50,000 every year.
Right.
Okay.
Which means by the end of 10th year, he will save 500,000.
Yes.
If his assets doesn't grow, it's almost assured he won't achieve his goal.
Yes.
Correct.
So because of that, the financial capacity, he may need to have a portfolio that has a higher level of growth, probably accompanied by a high level of volatility. So that he can at least have a chance of achieving his goal. Whereas for B, let's say he still needs to achieve $1 million, but he already have $500,000.
Okay.
And he can save 100,000 every year.
Okay.
So 10 years later, just by savings alone, he have 1.5 million.
Yeah.
So actually, he can afford, to just stay in conservative investments if he wants, and can still safely achieve his goal.
I see.
So that's where we need to consider as well.
I think these 3 things are all interrelated. Yeah. So, and I agree with you. I always, this kind of investment portfolio, I do see, aggressive risk rating, balance, or conservative. And I think nowadays, you guys make things very simple. Oh, client have this risk tolerance, blah, blah, blah. Then you can go for this. So it makes things very easy for both advisors as well as an investor, because you already design for it. You already consider all these 3 factors into it, just that which one will play out for them given their circumstances. So I think, that's the good thing about investment portfolios out there, right? Yeah.
I think the 3 things, right, is widely used. And I guess it's about like what I mentioned, about nuances of it. How do you exactly get the information that you need such that, you can actually help with the portfolio construction? So going back to the analogy of the house, right, I will take it as the volatility is more of whether the designer got to speak to you as a client and say that, how would you feel if I were to paint the whole house in red? I paint the whole house in the more exciting colors and all that. In terms of your time horizon, it's more of how long do you stay inside the house. Because if you decided to not stay in the house for only the next, probably you meet MOP period, after 5 years you decide to sell, you probably don't need to put too much effort into it.
Yeah, exactly.
And lastly, financial capacity, it seems like it's more of how much do you, how willing are you willing to, and how long, a little bit related to the time horizon, and I guess go back to the budget as well.
Yeah.
So how much budget do you want to put into designing the house itself?
Correct.
Because if you have a lot of money, you can do a nicer house. If you have lesser budget, I guess, you got to make do, and then you got to think of something else to complement, and help with that. You got to make do with the design of the house. So I guess it is similar to that point. I mean, in terms of the designing of the house itself. So imagine, if I'm the advisor coming in and I have all this information, and how do I really get started in building up the portfolio from here?
Actually, an investor probably would not be able to answer these questions by themselves.
Yes.
But you ask a person who has never invested, what is my tolerance to volatility? He probably don't have an answer.
Yeah.
So I think it's not just basically filling a form. It's actually a conversation and maybe scenario analysis.
Yep.
To help a person be able to have some accurate answer to those questions.
So it's really more of a visual kind of a thing.
Like an ID
And a
mock
conversation.
up, you know, and
ID
do the
mock-up,
3D
if
drawing.
Paint it in red color, will you accept it?
Like interior design, it's not just sending a form to you.
Correct.
Please fill in what you want.
Yeah,
It's a conversation. What if this?
Agree.
If I add this,
Scenario and
what
all
do you
that.
feel?
Yes,
Okay.
yes.
So I think that's why the role of a financial consultant is actually very important.
That's right.
To play that role.
Yes.
That's right.
So imagine right now as a consultant, I have all the information needed and somehow the clients manage to understand what I'm trying to get to them through the conversations that we have and all that. So how do they actually start to build a portfolio from there?
So you don't mean it's specifically to these three questions. It's basically just how to construct.
Yeah, how
Yes.
do you usually
Yes.
basically
How do you-
what are your
yeah.
thought process behind it?
Correct.
Yeah.
Okay. Yeah. So then, of course, we need to construct it with the end purpose in mind, which is, let's say if a different combination of the three factors I shared with you,
Yes.
what kind of portfolio will be suitable?
Yes.
Okay. So the topmost is usually asset allocation.
Yes.
So of course, the most commonly used ones are like equities,
Yep.
and bonds. But Unicorn, we also use gold as a pretty significant part, a meaningful part of our asset allocation.
Oh, that's
Oh, that's
interesting.
interesting. Yeah.
I mean, I
Have
find it
all over
interesting.
there. Yeah.
It's a bit like insurance. Yeah.
Okay.
Yes.
But this insurance actually did quite well over the last 25 years.
Yes, of course.
I'm sure.
Gold is
In fact,
going up.
over the last 25 years, maybe to many people's surprise, it did better than global equities. Yeah.
Okay.
Yeah. So that's first part. Yeah. So then, how do we mix all this in the right proportion?
Yes.
And through back testing. So we'll do some back testing to say that, okay, let's say if you want to achieve volatility that is somewhere not between 20 to 40%, max drawdown. Yeah. Then how to mix this together? Yeah. And then to achieve the highest or optimal level of return. Yeah. While not exceeding the level of volatility. Yeah. And then suitably maybe over that time horizon. Yeah. There's a low probability of losing money. So that's where at the broad level, it's how to use the asset allocation because each has its different characteristic.
Yes.
Alright.
Yeah. And that can be seen through history. Yeah. So that's number one. And secondly, of course, then that is just like the blueprint, right? Yeah. You still need to actually build the house.
Yes.
Yeah. Then that's where we need to say, okay, then what to use? Yeah. For example, let's say we decide to have US equity funds, for example.
Okay.
Yeah. Then how much percentage? Yeah, that's one thing.
Yep.
Yeah. And then we need to make sure that the quality of that assets is good. Yeah. So then that's where we look for partners like yourself.
Thank you.
Yeah.
Yeah, please come to us. Free advertisement. Yes.
To see that, do you all have the right building blocks for us?
Yes,
Hey, do you all, what's your quality of the brick? You want to build this kind of house?
Yes.
Yeah, does your size fit? Does your quality fit?
Ours marble.
Top notch.
Italian marble. Don't worry about it.
Sorry, should I use marble? Yeah, okay, yeah. So marble and porcelain, so
Yes.
that's where I look for, UOB.
Yeah.
Thank you.
Of course, then we will look around. It could be, nowadays it could also be ETFs.
Yeah.
That's right.
Yeah.
Then to look at the quality. So then we need to research into each of these building block to make sure that it can, when it comes out as a real thing, it can come out something that is satisfactory. Yeah.
Yes.
They can really give the kind of return and exhibit the kind of characteristic that based on the back testing it has done. Preferably even outperforming it. Yeah. So that's why in investment you call it the alpha. Yeah, we do hope to achieve some level of alpha as well. Yeah, through this good selection.
I see.
Yeah.
Okay.
And then there's also a part of it which where we may be a bit dynamic. Yeah. It means it's not a entirely fixed portfolio. Yeah, that never move. Yeah. So there'll be part of it because the thing is, there's still the macro economy. Yeah, there's things happening in the world. Yeah. And certain times, based on our research and study, it favors certain assets. Yeah. So we'll dedicate a certain part of the portfolio, not a huge one, maybe somewhere between 10 to 25%. That we can dedicate it for a more dynamic allocation. Yeah. then that's where we may have different assets at different time. And then we keep researching on this to improve. And that can be an additional source of outperformance as well.
Right. So that's where your alpha generation is.
Yes.
So, from the conversation that we're having, and I kind of pick up just now the keyword, the right proportion. Okay.
Yes.
One is right proportion. The other one is optimization, So, and of course, when you build the portfolio, and I like what we mentioned before, there's so many other kind of funds in the same asset category or even in the geographical location. And of course, we also agree with you that, you got to have some proportion, to be in the dynamic range to basically take advantage of the markets, because markets are always changing, right? You got to optimize it. Like right now, China is running, and then it's running well. So how do you actually optimize and capture all this alpha? But there's also one question, because there's so many other things, right? In a portfolio, is there such thing as many asset classes or too many funds? Because I have personally seen some of the portfolios, they can have about, within a portfolio have about 10, 15 funds. And sometimes I wonder whether that actually efficient or not, right? Or does it, overlap themselves? These are the questions that usually I will also ask and research myself. But maybe from your perspective.
Yeah, there should be a limit. But the limit could be different for different people to different people.
Sure.
Right.
Sure.
Okay. So maybe I use these two words, diversification versus diversification. Not sure if you heard the term before. So what is diversification in my view?
Yeah.
Diversification in my view is not just, I put all my eggs in all the basket, and then hopefully all will turn out well.
Yep.
Because if I put my egg or basket in the middle of a road, that egg is certainly going to all be smashed.
True.
So there must be a certain level of quality checks, filter, before diversification. Otherwise, we end up diversification. Because putting all the egg in different basket, and then maybe at the end 30%, get crushed.
Yes.
So you want to enhance that probability that all the eggs will turn out well. Although some may not turn out well, through accidents. But the thing is, we need to do that filter, that safety check to make sure as many can turn out well. And that's where the capacity lies. For example, if I'm someone working, and then I don't have much time to do research.
Yes.
Then I just put in 20 asset class. I won't know them well. So I may not even know if I'm putting in something that's a time bomb. Or even if I'm putting in something well, but when things, let's say, don't turn out, the price don't turn out well in the short term, I could panic because I have no idea of the quality of what I'm buying. And then if I see the price goes down 30%, I will start to have doubts. Is this really working? And end up selling at the worst time. So I think there need to be a dedicated research to make sure all the assets are of high quality. And that will determine the capacity. If I'm a full-time, if I have a team of 20 people, maybe my capacity is larger. And hence, probably, 5-7 assets class will be suitable. And then, but if I'm a busy person, maybe then it should be lesser. What I'm saying is we should know what we are investing, not just a blind diversification.
I think that's where the experts like Kek Wee basically comes in to basically do this groundwork, which is really important, because sometimes some clients' mentality is basically the more funds you have, the more diversified you are. But actually, if you really do the math, sometimes you're actually overexposed to a certain geographical area or sector, even though there's many funds under a certain portfolio. So for this kind of thing, you really got to break down, right? You really got to find the nuances in it, and that's where experts like you comes in. Basically, to make sure that risk is being mitigated, and I will really tell the audience that is actually very important
on an ongoing basis. Is there a hard and fast rule to say that the advisor have to help to how do the advisors help to maintain a profitable portfolio? I mean, let's start with the easy one. So if the portfolio is profitable, how do the advisors continue that? Whether is it rebalancing? I mean, in this world of investments, right? We talk about rebalancing it, or keep it there, safe and sound. Don't need to do too much.
So there's two parts. One I call it strategic. One I call it emotional, and both are almost equally as important.
Okay.
So strategic part is something definitely the investment team can do.
Yes.
to make sure that it suits the profile.
Yes.
And then all the assets are well monitored and looked after to make sure risk is minimized. So that needs to be done on an ongoing basis by the investment team. And in Unicorn, I think largely the investment team supports our consultants in that.
Oh,
Sure.
Yeah. So they don't have to worry too much.
Yeah.
It's the second part, the emotional part, where the consultant has a much bigger part to play
right.
than the investment team. Yeah. Because there's a difference between risk and volatility. And like what Edward rightfully mentioned, it's risk that we need to keep it minimal over time. But a lot of time volatility can translate to risk. Just like the roller coaster example. I mean, the roller coaster come back fine, but if it's too violent, I may not come back fine.
Yes.
So then that's where, of course, the initial profiling is important to make sure the right portfolio is used. But the ongoing, you can say, learning and education is also very important. Maybe I give an example. Stocks and real estate. A lot of people will think real estate is a lot safer than stocks.
That's right.
But if you look at actual empirical evidence, that's not the case. In fact, probably stocks over time do better than real estate. And it's because in real estate, the investor has got a less capability to sabotage themselves.
Okay.
Because of two things. Real estate is usually not very volatile. Or it's volatile, but you don't see it.
Yeah.
You won't go and ask your agent, hey, what is my property worth today? You just happily live in it or rent it out.
Yes.
And you also won't check the property guru every day. Right.
Yeah, true.
And even if you want to sell, let's say you have impetus, I think things are not going well, I want to sell.
Yeah.
You cannot sell immediately, it's not liquid. You got to call the agent, and the agent may need to find a few months. By the time maybe you cool down already. I think I said it was a panic decision. I don't think I need to sell.
Yeah.
And hence, you ride through it, and then over time you become continue to collect rental.
Yes.
Stocks, actually, volatility of stocks and liquidity of stocks is a basic advantage of the investor.
Yep.
But most people use their basic advantage to sabotage themselves. Because when you know the company, a lot of times, even over the crisis, when the price can drop 30-50%, it's time to buy. But if you look at empirical evidence, most people
Sell.
Sell.
Yeah.
Sell when it's high.
And the thing is, so easy to sell.
Yeah.
Go log in, click, sell already. Even before their rational mind can overcome their emotional mind.
Correct.
They've already sold it. Actually, I have an interesting story. This is what I heard on YouTube. So it was about a bank.
Okay.
So they do a check. Which category of their customers do the best in their investment return over time.
Right.
Okay.
So they said the second best are those people who forgot about their login.
Ah.
So they can't log in and change. So like what Edward said, I can't look at my portfolio. I won't get affected by it. And over long term, they do very well.
Yeah.
I think, who do you think is the best performing?
Best performing.
Which group of people?
Leave it to the advisors.
They said the best group are the people who are dead, but they haven't closed their account. So they have no way of switching their portfolio.
I see. Okay. It goes forever.
Goes forever and all.
Okay. Yeah.
So sometimes I say if we can take the emotional out of
Yes.
this activity.
Yeah.
In fact, we should do better.
Yes.
Yeah.
So it's really doing, sometimes doing nothing is doing something really.
Yeah. That's why we actually monitor. I mean, we have an investing committee. We meet every fortnight. But a lot of times we end up doing nothing. It's not that we don't want to do anything. If there's nothing to do, then let's do nothing.
Yeah, correct. So, last question. So, finally, in your view, what is the most effective thing an advisor can say to persuade a client of the value of a portfolio, having a portfolio?
I think one of the main thing is it goes back to the point. It ensures the longevity of the investments. Because I invest something that's not suitable, then I don't have the benefit of time, which can give me the compounding. Because I will probably get out, worse still at the worst possible time. And hence I don't get to enjoy it. So having, like I say, portfolio, like what I go to the first question, is having a well-designed house. Then it can be, to my level of comfort, to my level of preference. Imagine if I don't like red, and my house is all painted red. I can't live in that house. Right? I'll go berserk in that
Yes,
house.
yes.
Sometimes feng shui tells you need it.
Maybe just paint one corner, which I don't go. Yeah. So then but if I like the house, everything is designed to my comforts, to my preference.
Yes.
Yeah, then it allows me to really stay and enjoy the house for a long
Yes.
term. It becomes my sanctuary.
Yes.
Right.
It actually
And
calms
hence-
you down, I guess.
Yeah, and hence a portfolio has the effect. Yeah. So once you have that longevity, provided the assets is of good quality, then you'll go through a lot of turbulence. Yeah. But over long term, let's say 20 years and beyond, you actually see that, well, it will really serve you very well.
Yep.
Yep.
Yeah, and then that's the value of really a portfolio, which ensures you longevity of your investments.
I like it. Longevity is the key. Yes. And you need longevity in this part of the world, right? In terms of investment.
I think you mentioned the cycles is what, 5.5 years or so after that from peak to peak.
Yeah.
In
That
terms of
was
the crises.
that was the GFC.
I think now
So you need to
that
see
is
it out.
getting shorter.
I think it's getting shorter
Yeah, it's getting shorter.
and more intense. Yeah.
Yes. Okay. So to the audience out there, stop looking at your portfolio every day. Right? Markets go up and down, but think of the long-term objective.
man.
What are your objectives that you want to achieve in the long run, and work towards it. I think it serves a better purpose for your own investment, and also not so stressful for yourself, right?
They should do a survey.
Yes.
Do a survey to check which are the apps that you've been looking at it on a daily basis. I'm bet one of them could be one of the investments.
Yeah. And headline news are always very sensational.
Yes.
Because that's what news media is supposed to do, right? Catch your attention, read the news, but have a sit down, think about it, whether it makes sense or not. I think all these kind of thing really plays a part, and of course, listen to your advisors as well. They're there to handhold you.
Talk to the professionals.
Yes. They are
They are
doing
the
the job.
IDs. They're designing the house.
Correct.
Don't attempt it.
Got to work hand in hand.
Yeah.
Gotta work
I
hand in hand
agree.
with your
I agree. Yeah.
Great.
Okay.
Thank you, Kek Wee, for your time today. I guess
Thanks.
it's a
Thanks,
very
Roger.
fruitful sharing. I guess everybody has a better understanding in terms of. I mean, there are of course differences between a well-crafted portfolio and a recommended portfolio versus somebody going in and then getting your hands dirty trying to structure something out of it. But I guess to the advisors out there as well, it's also good to know that probably you have somebody at the back of your own firm helping you with helping you to monitor while you handle the emotional part of things. I think that is the key point, because when things don't go well, I think everybody gets emotional, and I think a lot of irrational behavior comes into play, like what Kek Wee mentioned, anyhow press and do what else with it. Best is to forget the password. Yeah, I think that's don't remember the password.
Yes,
okay?
just don't go lock in.
But thanks a lot, Kek Wee.
Yes,
I guess
thank you.
The audience have benefited quite a fair bit in terms of.
Oh, my pleasure. Thanks for having me.
Thanks, Kek Wee.
Yeah. So if you have any comments, please
Yep.
write it in on the comment sections. If you have any questions, we will answer them in the next series, which is actually our last session.
Yep. Please
So-
remember to ask me anything.
Yes,
Leave all
yes.
the comments.
Comments.
Below.
You do this? Yes. Okay, Ken. Thank you.
Thank you.
Okay. Bye
Cheers.
bye.
Bye.